Jamie was mentioned there about just adding some science to all of this, and I know it is a bit of a combo of art and science when it comes to capacity planning. So it's not right down to the letter. But how have you seen this develop over the years, and any comments to working with Jamie over that period to get this right?
Yeah, absolutely. So I just want to add to what Jamie was saying about getting the cost of goods right, because when you look at a normal accounting firm, they have fees in their P&L, they have fees received, and then all the costs goes under a category called expenses. Ours is more, you've got a cost of goods sold, you've got your opening WIP, your cost of the wages, and then your closing WIP, and gives you a gross profit. And that should be around, your cost of goods sold should be around 40%. If you're because that's the largest cost of your organization. If you can get that under control, then the profit would just fall out the bottom, because your fixed overheads are around 35%, and there's not much you can do with your fixed overheads, because your rent, your software is your software, and so forth, and it's pretty much fixed. And if you get around 35%, your fixed overheads, and your cost of goods sold is around 40%, then the profit will just drop out at 25%. And then if you can squeeze a bit more out of your cost of goods sold in terms of getting the team structure right, and right people doing the right kind of work, and they're at 85% productivity, and if you get all those boxes ticked, then you're going to have a minimum of 25% return. And at $1, if the goodwill was valued at $1 per dollar, then that's a 25% return on your capital. Now, there's not many other businesses out there, or investments like property or shares or anything like that, will give you a 25% return. The reason why we do this is to separate out how hard you're working versus how hard the business is working. So if we can get those KPIs right, and and get them working around 40% cost of goods sold, then you're working your business pretty hard, because often you could be doing all the work that the business should be doing, and you could have very good numbers, but if you're working really long hours, then the business isn't working. You're just doing all the hours that the business should be doing. So the harder the business works, the less you have to work, but the less the business is working, the more you have to work. And in order to identify how hard the business is working, is the reason why we present the financials in the way we do, with the cost of goods sold and fixed overheads and profit. And in order to work towards those KPIs, we work with this capacity planner. And as Jamie said, in the team, it's a bit like if you're running a soccer team, you've got different positions. You've got a goalie and a winger, and they all have different roles. So we have a client manager, a senior client manager, who deals with clients. Their productivity is very low, because they're communicating with clients. They're doing the sales. They're setting up companies and doing sales with the clients, and so their productivity is around 50%. But if at the lower end, where you have an accountant or a grinder that's just doing all the work, their productivity should be more at 80-85%, because they don't have any distractions. And as long as you make sure that when the work, before they start the job, that there's nothing missing, or as much of it is in, then they don't have to pick the job up, put the job down, pick the job up, and put the job down, and that costs money and time. So if you get all these things working, then you should end up with a minimum of 25% EBITDA, assuming $1 per dollar is the goodwill. And so, at my practice, we're doing about 33% EBITDA. So minimum 25, so an average of 25 is very realistic.
Okay. Jamie, add to that for us in terms of some actionable steps, and walking through, we're walking firms through this every day now in Wize Growth as part of the foundation planning sessions. what are some of the key points that you want to touch on here? And I welcome Thomas or
I think at a fundamental level, if we work through the capacity planning, first of all, for example, it's a great process to do straight away, but it's very good at the start of your financial year that you can work out, what a forecast of your actual fees will be for the year ahead. So, you get a pretty good feel of what you've just done in the current year in terms of actual fees.
Mhm.
And then, you should try and estimate, might be a little bit of growth, 10% growth or whatever it may be. But first of all, work out what your forecasted fees are for the year ahead. And that's really important because you've got to plan. What's that old saying? Those who fail to plan to fail. So the capacity planner, it's probably my number one planning tool at Sky Accountants, and soon to have 5 teams. So I just couldn't live without it. So that's probably the first point, Brenton, is estimate what your actual fees will be on a per team basis for the year ahead. The next point then is you really want to jot down, and you can see, hopefully I'm still sharing my screen there, but you want to jot down all your finders, minders and grinders, if you like, but at that level, like who the senior client manager is. And again, you've got a different topic another day, but get that team design right, the senior client manager, the assistant client manager, and so forth, and jot them down as you can see on the screen there. And then obviously list everyone's salaries in the capacity planner, because we're listing their salaries because we want to look at, ultimately at the end, we want to look at the profitability, as Ed mentioned, of this team. That would be the next thing. Obviously, you got to put how many weeks a person works, how many hours in the week that they work, and that'll give you the total hours. And then, as we mentioned at the very start about when I started working with Ed, well, what should people's productivity be, and what is productivity? And I remember in the time when I first started working with Ed, there was a lot of probably other coaches and commentators saying that, don't worry about productivity, just don't keep timesheets, don't worry about productivity, just fix fee or value price and the rest will fall into place. Nothing could be further than the truth, to be honest. So again, we can talk about what productivity is. So make sure you understand what productivity is. And then, the second point there is what is a person's charge out rate and how is that determined? So, and we can do a deep dive in those with Ed's help here and now. But obviously, once you calculate how many of their hours they're working, what their productive hours are by their charge out rate, you'll get an individual person's capacity. So the capacity is if they did those productive hours by their charge out rate, that person's full capacity is, say in this example, $206,250. That's their full capacity. So if you work through that for each individual, you'll get the capacity. And this is just for example, we've got an accounting team, and in this example, we've got a bookkeeping team. And charge out rates for bookkeeping, most people would know, are different to accountants. And also if you have an offshore team, then you can make your bookkeeping very profitable. And then obviously you have the overall teams or the overall firm's capacity. And in this particular case, I've just, for argument's sake, today's example, I've said, look, our forecasted fees is 600,000 in accounting work, and we've got about 150,000 in bookkeeping work. So our overall fees is 750, but our team's capacity is a bit over $1 million there, or $1,032,000. And so what that leads to is an analysis around what is the spare capacity. So if we've got 750,000 in fees, but if our team was working, all things equal, was working to their productivity and charging out at that right hourly rate, then we've got about $282,000 of spare capacity, or as a percentage of our capacity, around 27%. And one of the most important things I think I learnt with Ed was, one of the questions, well, why is the senior client manager only 50% 50% productive, or the assistant manager's 75, for example. Now, it's not an exact science, but what you have to realize is the role that these people are doing. So the biggest aspect there, Brenton, is to understand why a person's got that productivity. And if they're not doing billable work or chargeable work, what is that other 50%? And particularly if you're a client manager, it's talking to clients. It's talking to new leads, new referrals, having AGMs with clients, taking them through the process and telling them how good you are, what their tax outcome is, or if it's the bookkeeping, it's what their figures actually mean. And what I found is clients actually value, the biggest point is actually talking to the accountant or the bookkeeper. That's what the clients value. They don't really value the processing work in the background. While it's important, it's all about what the client's perception is. So it's important to make sure that you have spare capacity in the firm. And I'll probably bring Ed in here, but I would say 80 to 90% of the firms over the years of mentoring, I would say 80 to 90% of the firms don't have spare capacity to grow. And if you don't have spare capacity below, it's a bit like this glass of water. You probably can't see it there, but if that glass of water is full and I've got no capacity to put more water in or put more fees in, the cup's going to overflow. In an accounting or a bookkeeping firm, that means lack of service. You can't get the work done. You can't get back to clients. You simply can't manage your clients' expectations because everyone's just like flat out. And, I've spoken to that many accounts over there, a bit like Ed would often say that, like, I've just won another client, and their body language is like, oh, it's just pain. It's like, do I have to work Saturday to get this work done? So, whereas, someone who's leading a team who's got spare capacity, it's like, oh yeah, we can take on your work. We've got the people to do it. We've got spare capacity, and your whole psychology is different. So, yeah.
So just to voice on a point there, a question from Michael, Jamie, and Thomas has answered it in the chat, and it's on the spreadsheet there. Spare capacity, what's the sort of average range you want to keep in the firm? And Ed, you might elaborate on this as well.
Yeah, it just depends on how fast you're growing. If you're growing very, very fast, then you probably want more like 15% plus. If you've just been cruising, then you want at least 10%. And as Jamie used that analogy with the glass of water, if you want to grow, you've got to have, you've got to have that cup not at the rim, but you've got to have the water, 10% less under the rim, so that when you pour some more water into it, you can actually hold that water without it overflowing. Overflowing means, you're losing clients, you're not returning calls, you're not getting work done in the right amount of time. And if you get the balance right between the two, then you're going to have very happy clients, and they're going to refer work to you because they're happy. And this tells you, well, we think 10 to 15% is in the normal. If you go too much capacity, then, and you're not growing to fill that capacity, then you're not going to have a very profitable firm. You're going to have too many expenses, and your EBITDA will drop if you have too much capacity. And just like if you have too little capacity, that's going to cause other problems, like I said, long turnaround times and so forth. So getting that right is so important. So you should be looking at this constantly, especially when you're growing and you've like a team member's left and you've hired another team member. The first place you go into is this. And of course, if you're growing, before you make a decision to hire anybody, you come in here and you plan it out, and you make sure that you're planning your capacity to suit the level of fees that's coming in, or the anticipated level of fees that's coming.
Yeah,
you've got to be ahead of the curve. You've got to be looking ahead constantly.
And the key to it too is to make sure you work with your senior client managers, the leaders of the teams, Brenton and Ed. And as soon as you educate them, like these days at Sky, for example, as soon as one of the senior client managers wants to hire someone, they instinctively go to the capacity planner, because they know that that's what I'll go to, and they'll know that that's what I rely on. So it's really good when you get that culture where everyone's focused on the same tool or the same philosophy of how do we hire? You know, is it what's the process? So it was just like the other day, my senior client managers will always come to me and say, "Hey, JB, I've recalculated my capacity planner and I've looked at the fees of one race, you know, recently. I think I'll need another person." So it's just so good because you get on the same page strategically. Yeah.
In terms of allocating time, do you allocate a percentage of productivity to training or fixed hours, or how, or is it different for team member roles? Ed, any comments on that?
Yeah, you notice that the manager's productivity is less than, in that case, Jane, who's on 90%. So Jane is on 90% because she's got no management responsibilities. She's just there to grind, produce. So you notice that the others, the senior production manager there, Rose, her job is to manage the staff and train them. So you notice her productivity is at 70% because the other 30% is to make sure that she's training the staff. And then right at the top, Alec, who's the senior client manager, half his day is spent just talking to clients, right? And like Jamie said, the communication with the clients, the relationship with the clients, and you notice that his production is at 50%. Now, as Jamie said, this is not fixed in concrete or anything. This is all flexible. It just depends on your team structure and the experience level in those teams. Now, what we find though is if you get the senior client manager, in this example, Alec, doing more grinding work, right? So his production goes from 50% up to 80%, then you won't have as happy clients and you won't get as many referrals. So just getting the balance right is important between, servicing and growth. If you want to grow, you've got to spend more time in front of your clients, and the likes of Alec needs to do less grinding and more face-to-face work, meetings, Zoom calls, discussions, that kind of work, and then you'll get more referrals. But if you don't want to grow anymore, Alec can do more grinding work and you won't grow.
In that case, so the managers would do higher level training and then deliver on only the key concepts to the team.
Yes.
Yeah. Okay.
Right.
Do you disclose all staff salaries on your capacity planner to all staff, or just show the team total? Jamie?
Yeah, so once you've got all your teams structured right and the people in the right seats, as we say, only the senior client managers are responsible for their teams, Brenton, and they're responsible for setting the salaries. They're responsible for the annual performance reviews. So as a CEO, I'm there to support them in that, so I can be in the meetings if they want me to be there. But generally, and you get going as they get confidence up, you don't need to be there. So answer the question, yeah, only the senior client manager sees the salaries of their team members, and the rest don't know. The rest only know their own salaries. Yeah.
Perfect.
And it's the reason. The reason is that you want that person, in this example, Alec, to run that team. And if you constantly bypass him or her and do their job for them, including reviewing the salaries for their team, then they're going to just sit back and let you do it. So this is the concept of management from bottom up, not from top down. The top down management is where Jamie jumps in there and interferes and bypasses Alec and do all Alec's job for him or her. And he or she would just sit back and let you do it. But instead of doing that, you let them, that's their job. You can be there to support them, but you've got to let them do their job of running that team and take responsibility for that team. But you can reassure them that you're there to help them and you'll be there to guide them, but you're not going to do it for them.